So hi everyone, it's Grant Abbott speaking, and welcome to what is virtually Australia's first ever private annuity contract. So I'm going to go through, I've had probably around about 30, well, the first time I started looking at annuities was in 1988, so 32 years experience in annuities, and I know it inside and out. So all the rulings, there's a great ruling, IT 2480, if you want to know anything about annuities. A lot of this came out when there was the introduction of what we call a variable annuity in those days. Essentially, it was a forerunner of an account-based pension. So I've had a lot of experience in this area, and I just went through a process for myself and my parents, and I'll talk through that a little bit later on, by building a private annuity contract. And I thought, well, it worked for me and it works for my parents, so it may work for some of you. So I built the document. It's on our hub, which is our back end before we launch it into the system. But what I'll do is I'll get that up and running in the next day or so. Anyway, LightYear Docs private annuity contract. It's essentially an income stream, and the good thing about it is it provides certainty of income payments over a period of time, whether that is fortnightly, quarterly, whatever. So it's almost like buying a salary without having to do the work. So it's buying an income stream. Now, it may not be appropriate for everyone, but that release of money coming in each and every month can make a huge difference, particularly if people have got bills to pay, or, for example, in my parents' state of play, that they've just sold their house. Unfortunately for them, the best interest rate they can get is like 1%. And so what I've gone and essentially, to help them out, I've set up an annuity income stream which payable over a 3-year period, which really covers, with that and Social Security, covers a lot of their age pension care payments. So it means that over the next 3 years, we've worked out now that Mum and Dad have virtually got 10 years of money left, because it's virtually locked and loaded. And when you've just got this big lump and you're drawing down on it, there's always that fear. Whereas to get an income stream coming out each and every year, much like a reverse mortgage, as opposed to put it mildly, is a really great thing. So I'll go through the process, what we need to do, how you need to build it, and when you may use it. Now, you may never use it, but as I said, I found it quite useful. I'll look at the tax and also the Social Security consequences to it. I first got involved way back in 1988 when I was working as a tax manager at KPMG. I first started there after working as the research director of the Tax Institute of Australia. I wanted to go into private practice, so started off at KPMG, stayed there until I worked at Rothschild in 1994, then started my own business in 96 with the app name of Grant Abbott Consultants. So that was a lot of branding then. But anyway, one of the areas there is one of my clients. I was in the banking and finance division, not the superannuation division, but the banking and finance. And one of my clients was Citibank, and they had come up with an idea, and they just started up a Citicorp Life, so it had a life insurance registration. So what they developed was a 5-year term certain annuity with a 0% residual capital value. A residual capital value is obviously a final payment. So, for example, if you had $100,000 over 5 years, you would get potentially $25,000 each year with a 0%. Or alternatively, if it was 100% residual capital value, you'd get 5 payments of, let's say, $5,000, with the final balloon payment being the return of your capital being the $100,000. So it's a bit like a term deposit, but it was offered by a life insurance company. In those days, the underlying interest rate for the term certain annuities was around about 13%. It was a huge success, and a lot of the study that we did was primarily people over age 60 who sought to get an income stream or guaranteed income over a period of time. And at that time also, we found that they were able to because it was effectively like a deferred annuity, whereas annuity, you could put money in there and then roll it in for another 5 years and keep on rolling it in, keep it in the superannuation system. So it worked really well, and it went from virtually zero in 1988 to, by the time 1991 came around, there was $1 billion of assets under management in it. But the key thing about it was that, if you had those sort of rates of return, how are you going to make a good profit? And what they did is they're very smart. They used motor lease receivables. So, for example, 4 or 5 year motor leases. And it was really one of Australia's first securitisation packages. And it's very smart because obviously if you've got a lot of motor leases, in fact, they had, at one stage, they had 98%, because they were growing so quickly, 98% of all motor vehicle leases in Australia in 1990 were through Citicorp Life. Now, they might have been done through AGC or wherever, but it was then sold off to Citicorp Life, which was quite amazing, and it worked really well. And through that, they obviously had diversification, so that if a few fell off the perch, it wasn't a big issue. But the element there is they were able to do, I think, motor leases at 15 or 16%, sell annuities at 12%, and they'd have a 4% differential, which was sitting in their life insurance company. And because it was an annuity in those days offered by a life insurance company, which is the same these days, when you have a look through a life company, you have different tranches of tax payment. They call it different statutory funds. So, for example, you've got your ordinary stat fund, which is taxed at 30%. So that's just ordinary life insurance premiums, endowment policies, etc. Then you've got your superannuation policies, and then you've got your annuity super policies, obviously taxed at 15%, and ordinary annuities are taxed at 0%. So they made obviously made a huge killing out of the whole process. So, but I got involved and had to go through Section 27H of the 36 Act, which talked about the taxability, look at Social Security. I had to focus in on then if it wasn't from a life company, if it was from a private company, what it would look like. So I sort of got involved in that whole process. Now, annuities aren't really new. In fact, I think the first annuity I found went back to Roman times. But in Foley and Fletcher, which was the main case on annuities, and again, they've been a good stock standard system to provide an income stream prior to obviously superannuation. In Foley and Fletcher in 1858, Baron Watson said, and this is essentially, it's still used to this day, annuities means that where the annuity may be purchased with money, the capital is gone and ceases to exist, and consequently, the person to be charged tax is the person receiving the annuity, that is the yearly sum year by year. No capital is taxed there because the principal has been converted into annuity and the annuity is chargeable to tax. So again, if I went through that process of paid $100,000 to get 5 $25,000 payments over each of those years, then you'll see, we'll work out what the tax is around that. But what we'll do is once we pay that $100,000, that's not our capital anymore. Effectively, that capital goes onto the balance sheet of the provider or the issuer of the annuity, and really you've got no right or entitlement to that capital anymore. You've converted capital into an income stream, which can be a bit different. So that's a lot different from a loan, because if we have a loan, then on our balance sheet, we're actually going to bring in that asset being the underlying principal of the loan. Whereas in our if we have a look at our annuity, we're just simply getting a right to receive income over a period of time. There is no capital amount. We could bring the net present value of the annuity, generally would be brought to account for accounts purposes or on the balance sheet. But it's completely different analysis, which I've been going in and having a look a bit later, and I'll show you something a little bit cheeky a little bit later on that I was having a look at. Anyway, when we have a look at the benefits of an annuity, as I said, they're generally issued by insurance companies, but you can issue them privately from a company, trust, or an individual. An SMSF can issue to a third party. So, for example, I could go to an SMSF, pay, as I said, the the $100,000, and then over a period of time, I could go to your SMSF. I'll get an income stream from the superannuation fund. Now, it's not a life insurance company. That would be classified as a private annuity from that perspective. So if it comes out to me, then effectively it's a third party, so there's no in-house assets issues. Importantly, if I did it to a member, I'd be caught up under Section 65 because I'd be giving financial accommodation, because quite clearly there is some financial accommodation there. One of the ones, the cheeky one that I have a look at is that we can lend to, and those of you who used our SMSF lending package up on LightYear Docs site, we can lend to a related trust or a company. And if we do so, then it's obviously going to be an in-house asset. It's not caught under Section 65, but it's caught under Section 84 of the SIS Act. However, when we go down and have a look at what an in-house asset is, under Section 71, it talks about there, obviously, equity in a company, or alternatively, it would also include a loan or loan arrangements. So it may well be the case that annuity is not caught up in that process. So it's just something to think about, and I've got to get my head around it. I've only just been going and thinking about that one this morning. But essentially, if we have a look at it, it provides a set stream of income payments, which provides certainty for many people, particularly older members. So it takes that worry, for example, with my mum, that, you know, I'm going to run out of money when they see that each month there's money coming in. And then they've still got their underlying, the rest of their capital sitting in there. So it's not a bad little tool to be looked at. If it's private, obviously if you have a look at life insurance, I forget what Challenger offers at the moment, what their underlying rates are. But if you go to AMP, you're probably likely to get half a basis points on annuity over, particularly they tend to not do term certain, which is for a period of time. They do lifetime annuities, so they have to factor into account the age you are, your life expectancy, so on and so forth. So that's why there's such low inherent interest rates in lifetime annuities. Term certain is a little bit different, but even in these circumstances, we're looking at around about, you'd be lucky, as I said, to get 1% or 0.5% in terms of a term certain annuity. So from that perspective, you know, we're in a pretty good position. Obviously, if you're doing it, I did one for mum and dad, and I did it at a 6% interest rate. I really didn't need the money, but I just wanted to give them some. I wanted to give them some, I suppose, certainty over a period of time. Now, my dad doesn't matter because he's got dementia, so it's sort of not really on his radar. But effectively, what we've got there is essentially an income stream over that period of time, and it's taken a weight off shoulders of mum, because now she can see that, you know, she doesn't want to live that long. She's 86 now, and dad's 89. But look, you just don't know. I mean, you have a look at the nursing home, and there's some people who've been there for 15 years. In fact, one of the ladies there has just turned 102. So you've got to obviously stretch that money out as long as possible. So from the provider, which is me as the issuer, there is a lot of, obviously, there's a lot of the reverse side. I've got to make that $6,000 payment each and every month. So I'm going to have to make sure that with the $200,000 I secure it well. But it's worth it in the long run, because the number of times my mum calls me around money issues, stuff like that, at least that gets off the back at the moment, which is good. There's plenty of annuity calculators. In fact, you can find in Excel, there's plenty of ones, and I'll show you. There's a couple of there for you, so you can use. From a Social Security perspective, so I got this straight off the Centrelink site. This is for a term certain annuity as opposed to a life. I wouldn't recommend that you do a lifetime annuity. It just doesn't make sense, because it's too risky unless the person dies before your life expectancy. But essentially, if we have a look at the assets test, the purchase price of the income stream. So if I have a look at the one I did for mum and dad, it was $200,000. is the initial assets test, which makes sense. And then that's reduced every 6 or 12 months on a straight line basis over the product's term. So if we have a look at that, essentially over 3 years, because they assess it every 6 months, then every 6 months over a 3-year period with $200,000, it means that we've got so that's 6 payments, $200,000. So let me get my trusty calculator out. You'll have to, most of you can probably do it in your head, but I just have to check it out for myself. So from a Social Security perspective, I've got $200,000 divided by 6. So it's over 6 terms, so 6 6-month terms. And that means there's $33,333 of principal or assets which are reduced every 6 months. So again, it's a good wasting asset as well, and that has an impact as well. But the assessable asset can't be less than the residual capital value. So if I've got, for example, a 100% RCV, then it's going to be a completely different scenario there. So if I've got 100% RCV and I pay 200, then the assessable value for an assets test will always be 200. Now, for the income test, this is important. They are financial assets, and then effectively you use the deeming rules to calculate your assessable income. So I think the deeming rule at the moment is around about 2.25%, if I'm correct, and don't trust me on that one. But as I said, I'm offering it to mum at 6%, so they're better off down that track. So it actually can be a really good position for Social Security. Compare that to obviously the rest of their money, about $500,000 is going to be sitting in a bank account earning 1%, which means which is again subject to deeming rules, but you're on the reverse side of it. So on the income tax side, there's 2 measures that are in play. So, for example, if I've got $200,000 over 3 years and I receive a number of payments, then each of those payments has what we call a deductible amount under Section 27H of the Income Tax Assessment Act. So it's a straight line write-off of your capital over a period of time if it comes from a life insurance company, which isn't too bad from that perspective. But what it means is that if I've got each year, I would have much the same as a Social Security. I would have my income payments, and then from my income payments, I'd deduct $66,666 would be a return of my capital. So anything over and above that would be assessable income. With a private annuity, though, if you wade your way through, and I won't bore you going through all the sections, but essentially we use the rule of 78. And again, you can get this. You can see I've done a little calculator, and I'll put this material up on the website as well, or the slides up on the website as well. So it's a qualifying security, and it's catered for under Division 16E of the Income Tax Assessment Act. So you've got the provider or the issuer, and then you've got the annuitant themselves. So if you have a look at a 3-year $200,000 annuity that's got 36 payments, so we've got a monthly payment of $6,000, then effectively it looks like this. So you can see for the first period, so for the first month, I've got $200,000, which is sitting in my asset. I'm paying out $6,000. My interest payment there is $864. So for the annuitant, there's a good thing about that. For the annuitant, because it's qualifying security, that's included there in their assessable income. Now, because I'm the issuer, it automatically becomes tax deductible for me. It's just the way Division 16E works. Even though I'm doing it between my mother, she'll include assessable income, but I get a tax deduction for it, which seems to be a lot better than, for example, if I lent money to my mother, then she's obviously going to be paying, the reverse, if mum lent me money and then I repaid her, it'll be assessable, but depending on what I do with that money, effectively it's not going to be tax deductible to me. But as a Division 16E security, I get a tax deduction for it there, if that makes sense. So then we go down, and obviously at the end, that's where so it's a compounding issue. So there you can actually go through and work it out. So you can, if you have a look at it in the, you can have a look at it in Excel and just do the rule of 78, and that will cover you through that period. So that's the first 12 months. All of that are the interest payments, and then, sorry, I shouldn't be calling them interest. They are the assessable income payments and also the tax deduction payments as well. But these are the physical payments that actually go to the person. So when we have a look at that, we then go in, and I'll just go in and build one for you. So I've got here, sitting up on my screen, should have my annuity contract. If not, then I'll just go and pull it in. So this is our Hot Docs platform. We've been very lucky, and thank you for those who supported us. We easily reached our target. In fact, we're oversubscribed for our capital raising, which means we can then go and build the next system from Hot Docs, which will probably cost about $150,000, $200,000. But it's a much better system, still uses the back end, and we have that wraparound. So I'll just go in and I have a look here. So I'm just going to do, I'll do actually John Smith Annuity. And then I'll just go down here, and there's the annuity contract. So as I said, this will be available tomorrow. I'll put this up on to the system. So it's pretty simple. Then if we have a look at the document setup, so we'll just put John to James Annuity, and then we put our logo tag in there. So now the annuitant is the person who's actually purchasing it. So I'll just do a individual there. So I've got John Smith, and as I said before, you can be an individual, company, trust, or SMSF. Can actually be the the annuitants. That is, they're buying the income stream. If we then go into the, let's go to Sydney, New South Wales, 2000. So that's the first party. I can add another. So for example, if it was, in the instance of mine, it was both mum and dad, then I can put that effectively in there. The provider or the issuer could be an individual, a company, a trust, or an SMSF. So let's just say it's an individual. We've got James Smith, who is John's son. So what effectively has happened here, and you'll see, we'll explain it in the next one. So we've got the issuer, which is James, and then we've got John. So this is where effectively it's all done for us. So obviously it's going to be New South Wales. And this is the beauty about our system. All the guts, all the terms, everything that is built into the system, including, you'll see here, there's potentially a mortgage document as well to secure it, that effectively you don't have to complete many fields, but there's a lot of stuff going on in those documents. So the date of the contract, let's just say it's going to be on Monday. Commencement date, so that's the date that the first period relates to. So obviously if it's going to be $6,000, so we'll work that one out. But if it's going to be $6,000, then it starts at the commencement date, and that's really important. So we'll do it at the same day. Now, your date of contract and your commencement date can be two completely things. So for example, I could have the date of contract now, and I can commence it in 6 months' time, because the client or the individual, the annuitant, doesn't need the money now. They need it in 6 months' time. So anyway, I'm going to put in the annuity amount. So I've got $200,000, and there's no limit on the term that you can have. As I said, you can go up to lifetime if you want. You can even go beyond life. Typically, a pension or a true annuity, a lifetime annuity, can then have a reversionary annuitant, which might be a spouse, and that might be reduced, say 50% or 70%. So what's the underlying interest rate of the contract? So we'll just put 6% there. how many annuity payments that have been made, 36. So I've got my little calculator out, and the repayment amount is $6,000. I think it's actually about 6,074, but I'll just put 6,000. Now, put the charge property is, we'll just put the family home at 10 Bayswater Drive, Waters, Queensland, 506, well, it's not 5064, 4564. So, and that's it. So you don't really need to do much more than that. The Grant is actually doing that, doing the determination of the annuity. So what's happened there is, if we go back, I'll download this, but then I'll go back to relaunching the interview. Effectively, what we've got is the annuitant, being John Smith, has paid James Smith the sum of $200,000, and effectively for that, he will receive 36 payments of $6,000 with an inherent interest rate of 6%. But again, John Smith doesn't have that asset doesn't have that capital anymore. That capital is gone. This is one of the big issues that came up in the 90s, because we only had annuities at that stage where capital was gone. And then at that stage there was I forget the name of the company, but they introduced what we called a variable annuity. And a variable annuity enabled you to put in an amount. Your capital wasn't gone, and you'd be able to draw down amounts up to a certain amount. If it was an allocated pension or allocated variable annuity, between say 4 and 10% or whatever the rates were at that stage. And that was a first break from technically the law at hand, and that wasn't truly annuity, but it was able to be an annuity for superannuation purposes, etc. And that was the forerunner of the account-based pension. So that's how that came out. So let's just have a quick rip through the annuity contract, and then we can get you all on your way. I've just got a couple of little minor announcements. So here's your annuity contract. You'll see here, it's got your or my logo on it, but you can put your logo on there. So you got it between John Smith, the annuitant, and also James Smith, who is the provider. When we go down here, you can see this isn't a Word doc because I'm working off the back-end system, the hub. So from our legal perspective, our legal practice, we use this, and that way we can tailor documents if need be for you. Because of you don't want to get caught in providing legal services, that's why we provide it in a PDF for you. We've got the parties, the annuitant, and then the provider. Background, the annuitant will provide money to the provider secured over the property. The terms and conditions of the annuity are to be found in this annuity agreement and specifically in Schedule 1. So at the commencement date, the annuitant will purchase annuity from the provider for the period of 3 years, which I put in there, with monthly annuity payments to be made over that time. Term of the annuity agreement is 3 years. Interest rate, the inherent interest rate, which is what we put in there, is 6%. Repayment of annuity monies. Okay, I've got a bit of a typo there, so I'll need to go back and have a chat with my developer. Over the period, the provider will make 36 annuity payments to the annuitants. Now, pursuant to a separate personal guarantee and mortgage executed between the providers, give a charge mortgage or whatever. So you don't need to give a personal guarantee in this anyway, because you've obviously got an income stream, which by its very nature you're guaranteed under this contract. So, but what it is worthwhile is for some clients, if you want to be above board, is to make sure you have a mortgage or a charge over an asset to have that, and it's the outstanding value of the annuity. So redetermination of the agreement, so you can come back and redetermine it at any point in time. So again, there's another little typo there. You can see why we go through this before we finalise. Payout of the annuity amounts. So at any time, the provider may pay all the amounts without any penalties. Termination of the agreement, which is insolvency, etc., or breaching any of the terms. And then the annuity's rights on termination is to get full recourse. You've got your notices, all of that, and then it can be varied. And then down the bottom, we have our signing pages. So again, we've got there the provider, James Smith. We've got our witnesses in there, and then we've got John Smith, who's the annuitant, and the witnesses. Now here, we've also got the Schedule 1. So $200,000, 3 years, however, repayable early with no penalty. Inherent interest rate is 6%. Annual monthly repayments are $6,000. And then I should have put $6,000 per month. Commencement date, and then that's the charge property. So when we go down to the mortgage deed, we'll see there the mortgagee is obviously John Smith, the mortgagor is Jane Smith. And then effectively what happens is we've got John and James there. The mortgagee will advance monies to the mortgagor subject to the terms and conditions of the loan, are to be found in the loan agreement. I just need to change that. So that should actually be annuity agreement. They've missed out on that one. And the mortgagee will have recourse to property, blah, 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 blah. The mortgage holds an absolute beneficial entitlement family home at this. Mortgagee requests the mortgagee to advance $200,000, which the mortgagors agreed on mortgage. And then you can see here we've got all the annuity stuff. I've just obviously got to just make those one change, but that's pretty easy. And then we go through the mortgage deed, sign, and that's it. So you don't have to secure it if you don't want to. The mortgage deed will actually pop up for you. It would need to be registered, and effectively from that, we're now building a coterie of conveyancers around Australia who can register your mortgages, particularly when you go down the protector. But effectively, that's it's Australia's first private annuity deed. But if you've got any ideas of how you would use it, as I said, I use it for mum and dads, and I thought, well, this is a great opportunity to put it up on the platform. I'll look a bit more in that in-house assets issue because that looks a quite interesting one. But again, please feel free to come back to me. I like the difference because it's a Division 16E, that if it's accessible to the other person, then I get a deduction for it. Anyway, if there's no other questions, actually what I need to do is just do the final thing. So I need to do the final slide. So we went through here. The other one is, so next week on the 14th and 15th. So the 14th is Bastille Day. It's also my mum's birthday, believe it or not. And we'll be having our first virtual strategy summit. For you guys, you're already LYD members. If you haven't signed up, make sure you signed up. There's no cost if you just use the code NOCPD. That's all in capitals. And then just sign up, get your staff to sign up, because what will happen is once they sign up, then they get access to the videos going down the track. And you'll find there's some awesome videos. We've been putting them in the can already, tidying them up as well. Now, if you want CPD, there's $99 for 12 hours, which is great. But they're in, a lot of them in compliance and also professionalism and ethics. So they're in those ones that we don't necessarily get all the time. There's a lot of technical stuff in there, but there's a lot more about dealing with clients, because we're looking at having your best year ever from that one. If you're a tax agent, then the Tax Practitioners Board, it's self-assessment, but we've worked out there's 10 hours of CPE which are relevant to your role as a tax agent, which as you've got 60 hours over a 3-year period, is virtually half a year's requirements. So make sure you get online, you go on to the Virtual Strategy Summit, and then you can get that, so you can access that quite easily by just going on to our website up here. Press on there. As you can see, there's some awesome things, and just go on the Virtual Summit, and then go through your registration. If you want no CPD or you want CPD, it's just $99. Anyway, thanks a lot for today. It's Grant Abbott signing off.